Hey everyone, welcome back to the channel. Today we're diving into a great viewer question about the 10-year Treasury and its impact on the market, especially now that the Fed has been cutting rates. First off, if you have questions about investing, the market, or stocks, drop them in the comments or reach out through my Patreon for personalized insights. Let's get into it. The question: why would anyone invest in the 10-year Treasury when cash offers higher returns right now? And why does the 10-year yield keep rising, pushing up mortgage rates, even as the Fed cuts short-term rates? Why invest in the 10-year Treasury? Right now, a 10-year Treasury yields about 4.75%. On the surface, you might wonder why someone would choose this over higher-yielding cash options like money market accounts or CDs, which can offer rates closer to 5%. The key is locking in income for the long term. Here's an example. A money market account like Fidelity's SPACs offers high liquidity but is tied to short-term rates. 1. Its yield adjusts quickly as older securities mature, which can work for or against you depending on rate trends. 2. A 10-year Treasury, on the other hand, locks in your rate for a decade. 2. While it might not always offer the highest short-term yield, it provides stability and predictability. Imagine you have $1 million to invest. 1. A 1-year CD at 5% would give you $50,000 in year 1, but after that, your income depends on rates at renewal. 2. A 10-year Treasury at 4.75% guarantees $47,500 annually for the next decade, offering peace of mind if you expect rates to drop in the future. It's all about your investment horizon and whether you value long-term certainty over short-term gains. Why does the 10-year yield stay high while the Fed cuts rates? Here's the thing. When the Fed lowers rates, they directly control short-term borrowing costs, like the overnight bank lending rate. The 10-year Treasury yield, however, is influenced by market expectations for future inflation and economic growth. Even though the Fed has lowered rates by 1% over the last year, longer-term rates are set by the collective judgment of the market, not the Fed alone. That's why mortgage rates, which are tied to longer-term bonds like the 10-year, remain elevated. Higher yields on the 10-year can affect everything from borrowing costs for homes to how stocks are valued. While the Fed has tools to influence the market, like buying bonds, it doesn't have direct control over the long end of the yield curve. So even as the Fed cuts short-term rates, the market's outlook on inflation and economic risks keeps the 10-year yield elevated, which ripples across the economy. Final thoughts. Understanding these dynamics is critical for both short-term and long-term investors. Whether you're choosing between a treasury, a money market account, or looking at mortgage rates, it all comes back to knowing your goals and time horizon. If you found this breakdown helpful, don't forget to like, subscribe, and share. Also, join my Patreon for exclusive perks, including personalized Quanda sessions and behind-the-scenes content. Patreon, https://www.patreon.com/user. Ubidurd846114, Robinhood free stock. https://join.robinhood.com/ErnieB13. Thanks for watching, and let me know in the comments. How are you navigating these tricky market conditions? See you in the next video.